Folks, welcome to Best Stock Charts for the coming week. Happy St. Paddy's Day to everyone. Erin Go Bra, may the roads rise to meet you, and may the wind at your back always be your own. Let's kick things off with how we did last week in the markets. We took a loss on one position, but we booked profits on three others, so our P&L for the week was vastly greater than what was our single loss on positions that we closed out. Let's talk about our loss first. We took a loss on DPST. Our strategy as we went into last week was to ensure that our losses stayed very small. It was a very rules-based approach. And once we broke down below the lows of the 13th, we were stopped out, and thank goodness we were, because we proceeded down even lower. Now, while we bounced back later in the week, we are still showing signs of resistance, and we are still trading down below where we stopped out on the week. So this is when losses look like wisdom, right? You could feel bad about booking a loss on a new low, but when the shares continue down even lower beyond your stop loss point, you're feeling pretty good about yourself because you're not sitting with a losing trade. The other positions that we closed out last week were in the emerging markets area, EDC, the Direct Seeing Emerging Markets Bull ETF. Another one where we booked profits. Why do we book profits here? It's because the dollar was gaining strength. You had Larry Kudlow, our chief economic advisor, I'll get to him in a moment, come out and, for all intents and purposes, come out and upgrade the dollar and downgrade gold. And if you upgrade the US dollar, that's a downgrade of emerging markets. So once you see strength in the US dollar, you don't want to be around the emerging markets. So we book profits, we move to the sidelines. And this is the value that I think that I bring to our membership, is that we're not linear thinkers. We're not simply looking at a stock chart and saying, okay, it looks like this stock is going to go up. We need to take a look at other charts and say, what are the probabilities that this stock is going to go higher? What are the catalysts that will help propel, in this case, the emerging markets higher or lower? In this case, it was the dollar, which was gaining strength. Now, as we look to rebuild positions in emerging markets and in other sectors of the economy, we'll keep an eye on other indexes, other commodities, other currencies that will influence those positions, because that's what gives us an edge, a higher level view of a knowledge versus other traders. BRZU, another emerging market play where we booked profits here on the 14th. On the 15th, the shares gapped down. Why do we book profits? While the US dollar was one of the reasons, we also took note of the breakdown below the lower band of support on RSI. Our stochastics were rolling over, putting in lower highs, lower lows. And once you break down below the lower band of support on price, first out, best out. Move to the sidelines. Live to play another day. So we booked profits here on the BRZU. And we'll look to come back to these trades once again in the future, because we've traded them in the past quite successfully, with the exception of DPST. That was our first time. And if you want to hear prior commentary with regard to these positions, just go to the website and use the search box in the vlog area and type in the symbol, and you'll hear my commentary in the past with regards to these symbols. And the last position that we booked profits on was Cal-Maine Foods. Now, we saw topping action here. I was concerned that the markets would roll over. We had a hollow-filled candlestick on the 13th, which is a sign of indecision. I don't want to see indecision at the top of a trading range and where we have resistance above. Now, we did pull back as expected. However, on Friday, we did rally. So we're going to be looking to re-enter this position, because what I believe we're going to get is a pullback and a retest. Members, more to come on Cal-Maine Foods, but we were buying up Cal-Maine Foods back here as we were breaking out, and we added on strength. So a very nice trade here on Cal-Maine Foods. I like it longer term. Members, more to come. Let's talk a bit about the shenanigans that took place last week. Let's go to our zero hedge articles. The first up, I kind of went on a tirade about this because we are long of the gold mining stocks and they have been under pressure. The last thing that we needed was for Larry Kudlow, who is a great guy. I've met the guy, a very nice man. What you see is what you get on TV. That's the real guy, an eternal optimist. But when he was rumored to be the new economic advisor to the president, my mind immediately went to Larry's passion for King Dollar, a strong U.S. dollar, and that does not bode well for our gold position. So I was concerned. And sure enough, what did Larry do last week? He comes out and he offers advice, no less. So what does Larry come out and do last week? He comes out and he issues an advisory as if he's an analyst for CNBC. Note to Larry, you're no longer a pundit. You are now chief economic advisor to the president of the United States, and you shouldn't be issuing buy, sell recommendations. I have little doubt that Larry's comments added pressure to gold because the dollar rallied. And while I'm still longer term bullish on gold, and this is a minor event, because Larry's comments does not wipe away the fact that we have a national debt. This is also from Zero Hedge. National debt hit $21 trillion, and nothing the administration is going to say is going to be able to pay that debt off. And in fact, as noted here, aptly, and the real spending hasn't even begun. Absolutely right. Remember, infrastructure spending hasn't even been passed by Congress yet. It's coming, and it'll be bipartisan. It's coming through. Here is our debt since the election of President Trump, ripping through the ceiling. Why am I long of the gold miners and silver and looking to add more on a breakout? This very reason here. These chickens are going to come home to roost. Another article, and I'll post all of these links. If you're watching this on YouTube, go to the video description area. I'll post them there. If you watch this on the website, I will post them right above the video. This last article here, is the U.S. economy really growing? Spoiler alert, no. And what it's referring to is that absent the deficit spending of the U.S. government, we wouldn't have any GDP growth whatsoever. Prior to the 2008 collapse, for 50 years, our growth rate in this country was 3%. Over the past decade, 1.5%. And guess what, folks? The spending is only going to continue. It's only a matter of time before the Federal Reserve comes back and does another QE program. They won't call it QE. They'll probably call it cupcakes or something like that. But you'll know it when you see it, which brings us to the chart of the yield curve. We have the Federal Reserve set to meet next week. It's a very, very significant meeting. Why? It's the first meeting where you have Fed Chair Powell, who will be providing the answers to the media after the announcement by the Federal Reserve. What changes will they make to the verbiage? Not quite sure yet. But when you take a look at the yield curve, you can see that, and for those not familiar with the yield curve, it's when you have short-term yields which are trading on par or above long-term yields. It signals recession, and it has signaled the past 6 recessions. Now, while we rallied in February, we closed off the highs of the month, and this week we have a new monthly low. So it appears as though the downtrend on the yield curve has begun once again. And once we get down to 0 and below, that means that we have an inverted yield curve. The last time we saw that was just before the financial crisis. So keep an eye on this chart here, because the Federal Reserve cannot ignore the bond market. What the bond market is saying right now is that it is extremely concerned about the potential for a recession. And the economic data of late has certainly signaled that the consumer is weak and getting weaker. Last week, retail sales came out. We had a third monthly sequential decline in retail sales. That's the first time that has happened in 6 years. But the markets seem to ignore it. What the markets appear to be doing right now is seizing upon the occasional positive economic data, like last week at industrial production, which came out with a big beat. The prior week on the Friday job data You had a beat on the number of jobs created. However, the average hourly work week missed expectations, average hourly earnings missed expectations. So unless the laws of supply and demand have been suspended, I put into question the validity of those jobs numbers. Because normally when you get an increase in demand, you get an increase in wages, but that's not happening. So keep in mind this chart, if nothing else, this chart here, when Powell starts speaking next Wednesday about the future of interest rate hikes. Right now, the market is pricing in 3 guaranteed for 2018, possibly 4. Right now, the Federal Reserve is in a race against time, in their opinion, and that will cause them to do the wrong thing. What is that race? The race is that they are trying desperately to get rates higher before the next recession so that they can cut them again and come to the rescue. The problem is that they're nowhere near where they should be, and we are very close to recession. In fact, the Atlanta Federal Reserve last week came out and revised their Q1 GDP numbers to 1.9%. Keep in mind, they began their Q1 estimates at 5.4%. So this is a 60% decrease in their expectations, and it would mark, if they're accurate in this number, 1.9%, it would mark the second quarterly decline in GDP. With inflation on the rise, can anyone say stagflation? Think about gold. Sorry, Larry, I think you're wrong on that call. Okay, folks, now let's segue into the stocks that'll be featured on the week ahead commentary coming out to members tomorrow. These are the symbols that we'll be doing deep dives on to see how the technicals are setting up, how the charts are setting up for the coming week. If you want to skip around and go to your favorite symbol, I have posted, if you watch this on YouTube, I posted in the video description area below the symbols in sequence, and I've done the same on the website, but those symbols should be listed above the video. Members, tomorrow, I should have the week ahead commentary out to you before noon. And we'll do a deep dive of not only the weekly charts, but the daily charts, and when necessary, the intraday charts as well, to discuss the timing of our trades. Let's kick things off. I'm going to go over all weekly charts, that higher level view of why we're looking at them. And tomorrow we'll do our deep dive with members. If you're not currently a member, join up. Who is membership good for? It's good for newbies to the market who know little to nothing about charting and want to learn. For the advanced trader, you're going to get the macroeconomics and the higher level view using weekly and monthly charts, as I like to call it, multi-period charts, as well as focusing in on inverse correlations and correlations between stocks, bonds, and currency markets. So that's for the more advanced trader. For the newbie trader, we have plenty of commentary that comes out every day. It'll walk you through how to use the charts and how to minimize your losses. Let's begin with Valero, weekly chart. Again, all these will be weekly charts. Members, we'll do a deep dive tomorrow. We are in a triangle formation. A good week last week, and maybe say, Bob, it closed down on the week. That doesn't matter. We are in an ever-tightening triangle formation. We are at the tip of the spear. We are either going to break out or break down in all probability next week. The path of least resistance remains higher for Valero. We have RSI, which is rising. I'm a bit concerned about the lower high on Valero and the fact that we are rolling over here a bit, but we were overbought. We are consolidating all of those gains. So I wouldn't rule out getting long of Valero simply because of the RSI is rolling over a bit. Volume last week was slightly below average, which is good. So members, more to come here on this bullish setup for Valero. Oil. This is the UWT. You could trade the USO if you don't want the volatility of the UWT. For the past 2 weeks, we have retested the lower band of this ever-tightening triangle formation. We flashed a reversal week last week. We were down. We reversed the close higher. We did the same the prior week. This is all bullish stuff. The problem is that the dollar is showing some strength, and that is putting some weight on the oil stocks as well as oil itself. Stochastics, they are putting in a double bottom setup at the 50 level. This is bullish stuff, folks. So the question becomes, how do you enter this trade? And that's what we're going to discuss tomorrow on the Week Ahead Commentary with members. EREX, the Direxion Energy ETF, this has had a rough few weeks of late. Last week we pulled back and retested the support level, which represents critical support. We were down on the week. Volume was below average. So what do the energy stocks need to get propelled higher? Oil. So if oil begins to break out, and this is what I mean about advanced trading strategies, once oil begins to break out, we know that in all probability, the energy stocks will follow suit. If the ERX begins to break out, yet oil is lagging, I would question the sustainability of that rally. Members, more to come here. Sonesta Technologies, we discussed this one last week. It broke out last week. And you may be saying, Bob, horrible call on your part. It was down last week, 1.58%. A, we didn't buy it. B, I'm loving the setup here. Why? It's because we are retesting the breakout point. In fact, we did retest it. We traded down below it, and we closed above it. So this is a retest. We may get 1 or 2 more weeks of this stuff, but that's good stuff. You want to validate the fact that the breakout is for real. We have a double bottom setup on RSI. Do I like the fact that we did not break out last week? No. I would love to have seen a divergence here, meaning RSI breaking out while price had pulled back. We didn't get that, but that's okay. Volume was well below average last week. Good stuff. It appears as though we are forming a double bottom setup on stochastics. Way too soon to call that setup. So while I wouldn't go buying yet, very soon. Members, more to come tomorrow, meaning Sunday. MDU Resources, I have to love this setup. And every time I see a setup like this, I take a look at the daily charts and I shake my head because I know so many traders, members, we'll discuss this chart tomorrow, so many traders rely upon the daily charts. And this is fine if you're a day trader, if you're a very, very short-term swing trader, that's all well and good. But what you're doing is you're missing out on the higher level view and where the real money can be made. And that is on the weekly chart. And you have here a massive cup handle formation, and we are beginning to see signs of a breakout above this bull flag formation. And once we get the breakout here, it's going to be off to the races. So this is one of my favorite charts as we proceed into the coming week and weeks. MDU Resources, Stokes are hooking up, RSI is hooking up, all good stuff. Volume, outstanding last week. This is institutional demand. Ignore this at your own peril. Members, more to come on the Week Ahead Commentary. Las Vegas Sands, another one very similar to Sonesta Technologies, right? We broke out, we're pulling back to Las Vegas Sands. Same deal here. A very similar chart to Sonesta and in completely different businesses. Double bottom setup on RSI. Stokes hooking up higher. Volume last week light. So it was a down week, yes, and many people would just scratch it off of their watch list because it was a down week. No, what it's doing is it's validating the breakout right now. Me, I'm more bullish today than I was last Saturday when I was talking about the breakout above this upper band of resistance. This is all good stuff, despite the fact the shares were down. DRI, Darden Restaurants, in an ever-tightening triangle formation. We are putting in lower highs on both stochastics and RSI, and in fact on the Stokes, we're putting in lower lows. So there's a bit of a caution flag on the track there, but I'm not going to read too much into that. Why? It's because we're in a very tight trading range, and what that does is it skews the RSI and it skews the stochastics as they are momentum indicators. Volume last week was above average, but we closed off the lows of the week. Almost a doji star formation last week, a sign of indecision. So while I wouldn't go buying this quite yet, we'll talk more about strategy tomorrow on the week ahead commentary. Power shares, water resources. I spoke about this ETF last week. We did put in a new weekly high. Volume was very good. It was about average. Am I ready to buy it yet? Not quite yet, but soon. I love the fact that we have our stochastics rising and putting in higher lows. We had a higher high last week on RSI. So we'll discuss a strategy for those interested in buying the PHO tomorrow on the week ahead commentary. Kirby Corp. I've spoken about Kirby Corp in the past. Weekly chart. We had broken out back here the week of January the 8th. We rallied. We've spoken a lot about pullbacks and retests today on this commentary, and we got that pullback and a retest the week of January the 5th. We have since rallied off of support, so this breakout point, which at one point was resistance, is now support. And we are beginning to consolidate at higher levels above the 200-period moving average on a weekly chart, and we are poised for a breakout. We have higher lows getting put in on stochastics, all good stuff. We're looking for that double bottom setup on Stokes weekly basis, and we will look to open up a long position. And of course, it wouldn't hurt if we got a breakout above this. Let's update the chart. Be right back. Here we go. I added this upper band of resistance here. We'd like to see a breakout and a close above this upper band of resistance weekly basis. We would be very long of Kirby Corp. Members, more to come tomorrow. Shopify. We were long of Shopify. We booked profits. Now we're looking to get long once again. Last week was a down week. We did not put in a new weekly high last week, so we stalled a bit. So we're going to rely this week more upon the daily charts than our weekly charts. Our Stokes are still rising. RSI declined last week as expected. I still like to set up here as we did rally off the lows of the week. Members, more to come. Volume to the downside was very light. Members, more to come tomorrow on the week ahead commentary regarding the daily charts and perhaps even the 2-hour chart here or 4-hour chart on Shopify. And we only use the 2-hour and 4-hour charts as indicators of as to precisely when we want to enter the trade. We do not use those intraday charts for our longer term strategies. They're too volatile. We rely more upon our daily and weekly charts and at times monthly charts. Now, given the environment that we're in right now with a market that is lethargic, you're seeing attempted breakouts fail. You're seeing breakouts fail as well. That's a sign of a weak and tired market. You have a declining yield curve, and we are well into a business cycle that is long in the tooth, and we have a federal government that is running massive trade deficits as well as fiscal deficits. So what do you do in a market that is lethargic at best and quite possibly weakening? You look for opportunities where your risk reward is most favorable. And you'll be shocked to see that one of my favorite longs proceeding into this coming week is TCP Pipeline Partners. And in this case here, we'll use a daily chart, and you can see that using this daily chart, the shares have absolutely been crushed. And I know what many of you out there who are not familiar with my work are going to say. You're catching a falling knife. Every trading book in the world will tell you, don't catch a falling knife, folks. This is my bread and butter. But this type of trading is for the most disciplined of traders. If you do not have patience, if you do not adhere to a strategy, you will go broke. But here is my rationale of as to why I want to put on a trade here on TCP Partners. When I say put on a trade, you need to scale into your position. If you learn nothing else from this commentary, you must scale in. If you go jumping in on Monday morning based upon my commentary today with both feet, you're going to go broke. Don't do it. Because I think that in all probability, we can move lower. Now, the first thing that jumps out at me is that we have RSI well below 20. We closed out the week at 1375. Our Stokes are still declining. The price action is well below not just the 2 standard deviation Bollinger Band in green, but the 3 standard deviation Bollinger Band in red. It's not supposed to be there. I'll spare you the technical jargon. It's not supposed to be here. But why it is here and will probably stay here for another day or so is the fact that you have massive institutional distribution of the shares. If you decide that you want to fight these guys, you're going to go broke unless you have deeper pockets than they do. Don't fight these guys, folks. Now, when you're analyzing a chart of TCP or any other extreme oversold stock, you had better know if there is support below. And if there is support below, where are those potential buyers? Because those are the folks that are going to help magnify your ability to make money here. Why do I say magnify? Well, if you buy supposedly at the close on Friday, you had better hope that there are a bunch of other technical traders out there looking to buy at that support level. If there's no support level there, those technical traders will not be there to help support your buying. They will wait until the shares come to them. Now, to identify where there is historical support below, you need to go to your weekly and monthly charts to identify that. That is exactly where the conversation will pick up again tomorrow with members on the week ahead commentary. And that is where we want to begin our discussion of as to where we want to buy TCP partners, not the daily chart. We will go back to the daily chart to revisit the rationale of as to why we want to be a part of this trade. And if we see the shares gap up on Monday morning, thus alleviating the oversold condition, well, then we'll walk away from the trade. It's no longer interesting to us. The value that this trade has is the fact that it's just so oversold, and the probability of it continuing another week is so unlikely that that in and of itself provides us an edge over other traders. While you have panic amongst institutions, we see opportunity. Members, more to come tomorrow on the week ahead commentary. We're going to leave off today with SPXS. The SPXS, while we're looking to buy it, is actually a short ETF. Now, I have spoken a lot during this video about reasons why I am concerned about this market, whether it be the deficits, whether it be the fact that the Federal Reserve and the federal government are financing our GDP growth. I could set all that aside. The fact that we have not seen a breakout on the S&P 500 to new highs and the fact that we are stalling here is enough for me to say, you know what? You better take a look to the short side of this market, because if this market breaks support, and we'll discuss those support levels tomorrow on the week ahead commentary, we're going to want to look to begin to build positions in this market. I don't care if the market goes up or down. It doesn't matter to me. We'll make money in either direction. I'm confident of that. But you never want to go shorting the market on the hope that it will break. Why? It's because it's a sucker's bet. Because if you take a look at the 100-year view of the Dow Jones Industrial Average, the uptrend is indisputable. Despite many bear markets, the uptrend is indisputable. We remain in an uptrend, and to fight it is simply silly. You have an entire federal government, a plunge protection team willing to bid up this market ahead of midterm elections. So be aware of the higher level view of what's going on in this market. And that is the value that we at the Contrarian Trader provide. Back to the chart of the SPXS. Last week on Stock Charts Today, I discussed the performance of the S&P 500 pre-market every single day. I do not send those videos out to non-members, but I do post them on YouTube. Subscribe to my channel on YouTube if you want Stock Charts Today. Or follow me on Twitter, StockTwits, Seeking Alpha. Now, what I mentioned all last week was that every morning we saw the futures that were trading bright green. And I warned, they are manipulating the futures markets in an effort to get the little guy in to buy the market in the pre-market and in the first hour of trade. That is for amateurs. And I warned, do not go doing it. What happened every single day last week? The rally faded. That is a sign of a weak market. Now show me a futures market that is down big, triple digits on the Dow in the morning, and then it reverses to close higher on the day. That is a bullish setup. But we don't have that right now. So what we're looking at here on the SPXS are higher lows on RSI. Stokes are hooking up to form higher lows. We have broken out above resistance on Stokes. We are putting in higher lows on price. We haven't broken out yet. So tomorrow what we're going to do is we're going to talk strategy of how we plan on hedging our positions in this market. I'm not ready to get net short yet. But we are coming close. We booked a lot of profits last week and we raised cash. Now, volume last week was very strong and we closed well off the lows of the week. Ultimate oscillator rising. All good stuff. Now it's a matter of when do we buy, how much do we buy, and when do we add more? Members, we'll talk more about that tomorrow. Folks, if you're not receiving these videos and you want them in the future, enter your email address on the website. We hate spam too. You'll not be spammed. If you watch us on YouTube, follow me there. Hit the bell. Get notified of future videos. Leave a comment below. I'll definitely get back to you. If you found this video through StockTwits, Twitter, Seeking Alpha, follow me there. Share this with a friend. Get the word out there. And I will talk to you soon. Happy St. Patrick's Day. Everybody enjoy the remainder of your weekend and have a profitable trading week. Be well.